All right, I'm recording this video on a new laptop the university's given me, so hopefully the sound and resolution are going to be okay. But we're going to suffer this video at a minimum before we figure it out. So, all right, as I mentioned in class, I provide a video lecture each week. The idea is you watch the video, I give you a quiz. The quiz is based on what you see in the video. So I really do encourage you to watch them. You should, of course, do the reading as well. And then we're going to come to class and just do what I call in-class exercises, which is applications of the items that over the years I found students struggle with the most. And we'll also have a chance to work on any homework problems that you guys were struggling with. So, we're using class time to do things, and you can use out of class time to watch me or listen to me, or neither of those. Okay, in any event, holy cow, let's just get going, right? So let's take the screen up. We're going to talk about chapters 1 and 26. I'll probably break the video into parts so that it's a little more consumable, but it's all going to be in there. So we start with calculating the tax base, and for those of you that sat in class, you may want to advance. And in fact, if I remember, what I'll do is I'll stop the video at the point at which we finish the in-class lecture, and therefore you can skip this entire video and just move on to the next one. But in any event, a tax is based on a tax base times a tax rate. And a lot of times we think about the rate as being a percent, and the base often is dollars for us, right? US dollars. So let's start easy. We got Mark, who's a single taxpayer. He's got taxable income of $60,000, and we want to calculate his income tax liability. So we have his base. The base is $60,000, but what we don't have is a rate. And what I've done is provided for you a table pack. And as I mentioned, the table pack is used on every exam. I give you a clean copy because unfortunately experience has shown me I can't allow you to bring your own. So instead I give you a copy in each exam, and then I collect the copy of the table pack at the end of the exam so that we can reuse them during the entire semester and save a few trees that way. In any event, we now have a rate table because we have table 3, unmarried individuals, and Mark is single. And we can calculate the tax that's going to apply on the $60,000. So let's jump out to Excel and do that. Okay, so now we're over in Excel, and I brought a picture of the rate table. And as you recall, we had a taxpayer with $60,000 worth of taxable income. So what we're going to do is go to the bracket that encapsulates the $60,000. So that's over $41,775, of course, less than $89,005. And we're going to take $48,007 plus 22% of the amount that's over $41,775. Whoops. You'll have to suffer my typing every time I do Excel. And like I said, I'm on this new computer, and the buttons are just a little bit different than they were on the other one. Okay, so multiply that by 22%. See, all sorts of problems here. There we go. Add to that 4807.5. Wow, 4807.5. I'm going to drive you guys crazy before this is over with. And there's 8817. So there's Mark's tax on his taxable income of $60,000. Pretty straightforward. All right, let's jump back to our slide. All right, so we took care of Mark. Let's go into our next one. And this one is a bit more difficult. So we got Dylan, who's got taxable income of $50,000, and that includes long-term capital gains of $10,000. Okay, so I said it was deceptively difficult because it is, and that's because in this situation we're definitely going to need to use the same old table because Dylan's a single taxpayer as well, but we're going to add to that the long-term capital gains rates. So somehow we need to apply this table and this table because Dylan had long-term capital gains. Okay, so let's jump out to Excel and take a look at that. Okay, so we've got Mark's $50,000 down here. And sorry, I know that's a little bit small, but in large part I'm trying to make these giant graphics fit. and not taking the time to shrink them. Anyway, so we got 50,000. What we actually need to do is bifurcate that into its two pieces. So 50,000 is the total taxable income, but recall he had 10,000 of long-term capital gains. So what we really have is ordinary income of 40,000. So we can run the 40,000 through the same machine that we just ran through the 60,000 earlier, right? Except this time we're in the bracket between 10,275, 41,775. So let's go to 10,275. What's our excess? Multiply that by 12%. We get 3567. To that we're going to add 1027.5. Sorry you guys. I'll get there eventually. So there's our tax on ordinary income. 45.94 but we haven't resolved what to do with this long-term cap gains. And if we look over here, if we have a single taxpayer, it says that for taxable years in 2022, the maximum zero rate amount in the case of any other individual is 41,675. 41,675. Notice that's pretty close to this number, but it's not the same. And that's actually because when they passed the Tax Cuts and Jobs Act of 2017, they forgot to make them match. So, and no one's prepared to go in. Like Washington, things are so crazy. They're not willing to go in and be like, yeah, let's just fix that. Can't we? Yeah, no one wants to fix it, so they're not fixing it. Okay, so the question is, how do we tax that 10,000? Well, 10,000 is less than 4165, but the way the tax law works is a little bit different than that. Basically, what we have to do is increment the 40,000 first. Okay, so we're trying to get to this magic number of 41,675, and you can see that the difference between those is 1675. So that first 1675 of long-term cap gains is actually going to be taxed at 0% because that's under the threshold. However, the remaining 10,000, which is 8325, that's long-term cap gain, but because that's in excess of 41,675, that's going to be taxed at 15%. So we multiply that by 15%. And now we can add the two taxes together to get our total tax, right? So let's roll through that one more time, just a little bit quickly. Whoop, man, I am really having a... There we go. One more time to make sure we understand. So first we bifurcate our total income into the two parts, right? The ordinary part, and then ultimately we got to deal with the two chunks of the capital gains part, those two items, right? So ordinary was super straightforward. We got that. Then we looked at the capital gains, and we have to layer that on top of the ordinary income we've already recognized. That's just the way the tax law is written. So that first 1675, which is up to our threshold of 41,675, is taxed at 0%. But of course, anything above that, all the way up to 459,750, is going to be taxed at 15%. So we just add those two together and we get our total tax. All right, let's head back to the video. Okay, so I described that, if you recall, as deceptively difficult. And that's because it kind of is deceptively difficult, right? When you get into this having to bifurcate into long-term cap gains. And we're going to see that these long-term cap gains rates applies to qualified dividends as well. Okay, so let's do another example, but let's choose a different tax this time. Let's choose employment taxes. So Mark has taxable income from wages of $72,950. And we need to figure out what is Mark's share of employment taxes. Well, we have our base. The base is wages. That's compensation, $72,950. But what are the rates? And employment taxes basically come in two joint flavors, Social Security and Medicare, or sometimes called the FICA tax. So the Social Security rate is 6.2%. The Medicare rate is 1.45%. And what we need to understand, I'm going to skip down here, that FICA taxes are borne equally by the employee and the employer. So Mark's going to pay the 6.2 and 1.45, and Mark's employer is also going to pay the 6.2 and 1.45. Now, the Social Security portion of employment taxes is subject to a cap, meaning nothing above that is taxed. And the FICA cap in 2022 is $147,000. Well, we can see that's not really going to apply to Mark because he's well below $147,000. There's also an additional Medicare tax. Whoops, sorry about that. There's an additional Medicare tax of 0.9%, but that's on wages above $200,000 or $250,000 if you're married filing joint. And again, Mark is well below that, but we might have to cross that bridge later on. So a little familiarity probably makes sense. Okay, so let's go out to Excel and calculate Mark's employment taxes. Okay, we're back in Excel. We've got Mark 72,950. And let's recall what the situation is here, right? So we have an employee tax for Social Security. That's 0.062, right? 6.2%. We've got a Medicare tax for the employee of 0.0145%. And then we've got the employer share. And those are matching amounts. I probably shouldn't retype them. I should just do it like that. There we go. Okay, so if we do it in total, the total Social Security tax is 12.4%. The total Medicare tax is 2.9%. We can just add those two together and get 15.3. So if we're just trying to calculate what are total employment taxes, done. Done and done. Right? Very straightforward. If we instead, so let's delete this off here for a second, and let's move this over to here, 72950. If we wanted to calculate the separate components, which, you know, sometimes you want to do that, you could have the employee and the employer share. The employee share is that times the total for employees. Put some brackets around that. Whoops. There we go. And that's, yeah, the employee share. The employer share, the rates are the same. So it's the total amount. If we add those two together, isn't that the number we got earlier? Let's hope so, right? We'll calculate it out just to be safe. There you go. Okay, so that's the basic version of employment taxes. Let's head back. So we took care of Mark, but what about Helly? So Helly has wages of $152,000. So let's calculate her and her employer's employment taxes. So before we can do that, I'm going to provide a little more information about the employment tax rate structure. So one of the things I like to do, and I'm sure it's because I'm a visible learner, is I like to see these rates in tables. When I see the language descriptive versions, I kind of get lost and I swim in a little bit. So let's start with the Social Security tax, and you can see that everything from 0 to 147 is taxed at 6.2 employees, 6.2 employer. And that FICA cap kicks in, and it means everything above that amount is taxed at 0%. Medicare tax from 0 to 200,000 is that 1.45 we looked at earlier. But above 200 or 250 married filing joint, you actually add a 0.9%. Remember, we talked about that. And note that the 0.9% doesn't apply to the employer. It only applies to the employee. So we get asymmetry once we crest that kind of high wage amount, you know, considering 200,000 or 250 married filing joint is a pretty high wage amount. Okay, so all that's great, but we really still haven't dealt with how are we going to figure out Helly's taxes. So let's remind ourselves of the amount. It's $152,000 and head out to Excel. All right, we're back in Excel, and we've got the magic number of 152,000. Looks like I polluted the screen. I put it everywhere. No need for that, right? So we need to calculate the two parts, and this time I'm going to be discreet. I'm not going to jam everything together, as tempting as that would be. So when we think about Social Security tax, our base is 152,000, but remember it's subject to a cap. So the maximum amount that's subject to Social Security is only 147,000. So when we calculate the Social Security tax, it's only 147. And we can actually just reflect that exact same thing for the employer. Very straightforward, except that that needs to stay at 147. Oops, 147. There we go. Okay, so there's the two parts of Social Security. Medicare does not suffer a cap, and remember we had to get over 200,000 even as a single person for that additional 0.9 to kick in. So our true base for Medicare is the full 152,000, and our rate is the full 1.45. And again, we can just take those amounts and copy them over. Oh, I put them in as formulas. Sorry. We'll just replug them in. There we go. Okay, so now if I want the total amount that relates to the employee, if I want the total amount that relates to the employer, and I can add those up. And there's my total employment taxes on 152,000. Okay, again, making sure we apply that cap to the Social Security part. All right. So what's our next tax? Our next tax is the transfer tax. And most people are pretty unfamiliar with transfer taxes. They probably heard of them in some way, shape, or form, but they probably never spent a lot of time with them. I know I give them pretty short shrift when I teach 332, so I'm suspecting the professors Marino and McKenzie do the same thing. Pardon me while I get a drink of water. So what we're going to do is we're going to spend a little time so I can familiarize yourself with these taxes. Now, what is clear about transfer taxes is they largely only apply to the wealthy. And as I roll through how the rate structure for transfer taxes work, you'll see why that's the case. Okay, so what are transfer taxes? They are a tax on the transfer of wealth. So in the United States, if you transfer wealth from yourself to someone else, there's actually a tax on that. And that tax applies whether you give it while you're alive. We call that a gift, right? That's an inter vivos gift. Or if you give it away at death. Because again, you can't take it with you. So when you die, you usually give it away. So both of these are part of what we call the unified transfer tax. Gift and death tax, they kind of go hand in hand. And the tax, the transfer tax, is paid by the giver, not by the person who receives it. So in a way that feels, non-intuitive, right? In a way you think like, oh, the person who gets all the money, they should be the one to pay the tax, but that's not the case here. There are three primary exclusions to the transfer tax. The first is the marital exclusion. And what that means is you can give as much as you want to your spouse at any time and exclude it. So I could transfer all my wealth to my spouse and exclude all of that. For gifts, there's also an annual exclusion up to $16,000 per donee from each individual donor. So what that means is I have 3 sons, I could give each of them $16,000 and I could exclude any tax on those gifts because it's under the $16,000 limit. Let's say that I decided to also give $16,000 to my nephew. Well, I can do that as well, right? Because per donee, right, per person I'm giving it to, it's still only $16,000. It is from each individual donor. So since I am married, my spouse could also give $16,000 to each one of those same people. So they get a $32,000 gift and there would be no transfer tax on that. Okay? That's the second way to get out of transfer taxes. The third one, and it's the reason that only the wealthiest pay transfer taxes, is you're also eligible for a unified tax credit. And that tax credit lowers your tax liability dollar for dollar. And we'll calculate that credit eventually, but it's consistent with or equivalent to being able to take a deduction against your total transfers for just over $12 million. So what that means is I can give away $12 million and not pay any transfer tax. But if I pay $13 million, now I'm probably going to have to pay transfer taxes. So that's why it really is only for the wealthy, because I don't even have $12 million to give away, much less 13. Okay, how do you calculate gift taxes? So this is the gift tax formula, and we'll walk through some examples of this so you don't need to get too bound up in it. But you start with the fair market value of all the gifts you made. So you add up all your Christmas gifts and all your birthday gifts to any one person, remember, because you do this by donor. And you'd say, okay, well, I didn't give anything over 16,000. Well, no, I don't have any. But in theory, you'd add them all up, and then you deduct those exclusions we just talked about. So one was the 16,000. Another one is the marital deduction, right? We talked about that. But another one is you can actually give things away to charity and not have to pay tax. So think of those as you put them in, but then you take them right back out. So those are non-taxable transfers, even to begin with. Okay, so once I've deducted all those exclusion items, then I get to my taxable gifts. To that, I add any taxable gifts I've given in the past since 1976, right? So technically it's since 1976, but neither here nor there, because this is a lifetime transfer. You accumulate all your wealth transfers over your entire lifetime to establish what the tax is going to be. So you take all those gifts, you multiply it by the unified transfer tax rate, and we'll get to what that is in a little bit. That gives you a tentative tax, right? That's your base cumulative taxable gifts times your rate. That gives you your tax. From that, you're eligible to deduct any transfer taxes you may have paid in prior years. So to the extent I gave gifts in prior years, I maybe paid tax in prior years. Well, you shouldn't have to pay tax on the same gift twice. And the way that's done is you now reverse out anything you've paid. Then you can apply the unified credit. So you might say, well, look, I've got $12 million worth of credit deduction that I can apply. Excuse me, don't mean to yawn. The unified credit bores me, I guess. So then I could deduct the credit equivalent to that deduction, and that would give me the gift taxes I actually owe. Okay, so Dylan makes a $100,000 gift to his friend Irving. He's never made any taxable gifts in the past. If he chooses not to elect to apply any unified credit, what is his tax? Okay, so we start with what's the fair market value of all the gifts he made? Well, he made one gift, it was for $100,000. So the first thing he can do is exclude $16,000 of that. So $16,000 is off the board because that's the annual exclusion in 2022. So really what it amounts to is he's only made an $84,000 taxable gift. And recall, he didn't make any gifts in prior years. So we've got our base. Now we need to look at the rate, right? What is the rate that applies to gifts? And here's what the rate structure looks like, this table over on the right. And you can see that 0 to 10, it's at 18%, 10 to 20, it's at 20%, 20 to 40, 22%, et cetera, et cetera, et cetera. So we're at 84,000. So on the left-hand side, I've shown the calculation, the computation of the tax for each of those brackets worth, right? So 10,000 at 18, 10,000 at 20, 20,000 22, et cetera, et cetera, et cetera. And then that remaining 4,000 to get to 84,000 is at 28. Do the math on that and you get $19,320 worth of tax. Now that we have that information, we say, okay, well, the tentative tax on gifts is $19,320. We're not applying any credits to that, right? He hasn't paid any taxes in prior years because he hasn't made any taxable gifts in prior years. And so his total gift tax this year is in fact $19,320. Okay, let's redo this example, right? Same example, except now we're going to assume he applies the unified credit. So now we actually have to convert this deduction, this exclusion amount, into the credit that we're eligible for. And that credit amount and the exclusion amount change every year. They're adjusted by inflation. Last year it was $11,700,000. This year it's $12,060,000. So how do you do that? Well, you actually go back to your rate table and you apply the exact same math. So let's go back to that table for just a quick second and notice that, everything's taxed all the way up to $1 million. I'm at 39%, but then everything above $1 million is a flat 40%. So one of the things that we can do to make this convenient is, well, we'll take the total amount of the credit, $12,060,000, get rid of the $1 million and multiply that by 40%, because we know that's the rate that would apply, is 40% of whatever that amount is. Then we're going to add 345.8 to that amount. So what is 345.8? 345.8 is the cumulative total of all the taxes up to $1 million. If you were to drag that all the way out, do all the calculations like we've done on the left, except all the way up to $1 million, you would find that the tax is 345.8. Add those numbers together and you see that the unified credit for 2022 is $4,769,800. Okay, so we calculate Dylan's gift tax the exact same way that we did before. Total gifts of $100,000 excludes the 16. He's at 84. Multiply it by the tax rates. We get the 19,320. In this case, he's just going to use his unified credit. So he's using up a part of that lifetime credit against the gift that he made this year. And what that's going to do is reduce his credit in future years. But at least he doesn't have to pay any gift taxes this year. Okay, so we're going to skip that page because I've reconverted it into this nicer page. And this is how you calculate estate taxes, right? So again, gifts you give while you're alive. Estate is what you consider what you're giving away when you die. So you value the gross estate, that's the fair market value of everything you own. And then you get to deduct from that your funeral expenses, because that seems fair, right? You shouldn't have to pay tax on the value of your estate if you have to spend that to pay to bury yourself or cremate yourself or whatever, have your ashes sprinkled, whatever your choice is. You get a marital deduction, not a martial deduction, but a marital deduction. Well, I guess it depends on your marriage. It could be martial. Again, a deduction for charitable contributions. And of course, if you owe money, you get to reduce your estate by the amount of money you owe, right? Because again, you're not going to have that. That's not a gift. You're going to have to pay off your debts. That gives you your taxable estate. To that, you add all the gifts you've made since 1976. And remember, this is a unified transfer tax. So we're going to add together all the gifts you've made, so gifts you made while you were alive and the gifts you made while you were dead. That's your tax base, right? Think of that as your total lifetime gifts. Apply the unified transfer tax rates, the same rates we saw before. Get a tentative tax. Apply the unified credit. Reduce it for any gift taxes, again, that you've already paid, right? If I've already paid tax on that transfer, I shouldn't have to pay it twice. Then I'm left with whatever amount I have to pay for the current year. So a couple of things. The estate is typically valued at the time of death, but there is an alternative date for valuation if it's lower and it results in lower tax liability. That's generally 6 months after the date of death. And notice how gifts became part of the unified transfer tax calculation, right? So they become buried inside the calculation, because here we are adding those taxable gifts in. We're adding them in, right? Total lifetime transfers. Again, the rates that apply are the exact same rates we applied to gifts. Yep, good enough. Okay, so Dylan dies. So the Dylan who gave our $100,000 gift, let's say last year, right? So in 2021. He dies, leaves an estate of $13,500,000. He donates $500,000 of his investments. His funeral is expected to cost $50,000, and he's got debts of $350,000. The remaining estate is left to his cousin Steve. That's me. So I wish. Let's start with the Dylan that paid gift taxes, right? So we're going to start with the version of Dylan that gave the gift earlier to his friend Irving and went ahead and paid the gift tax on it. So we start with his gross estate, $13,500. Then we get rid of the things he gave away, the $500,000, his funeral costs of $50,000, and his debts of $350,000. That's a total of $900,000. So his taxable estate, the amount of the transfer he's making at death that is taxable is $12,400. Taxable gifts are $84,000. We calculated that previously. So his tax base is $12.484 million. So now we got to take that base and apply the rate. So how do we figure out what the rate is? Well, we're going right back to these tables, right? So we got $12,484 less $1 million times 40%, right? So we're reducing it by that $1 million, the tax, it's all the crazy rates, to just lock it in on the 40%, and then we're just going to add the 345.8. So as it turns out, the tax on an estate of $12.484 million, $4,939,400. So now we can plug that in. We can reduce it by the amount of the unified credit. Remember, we calculated that a few slides ago. Let's go back and take a look, didn't we? There it is. Here's our unified credit, $4,769,000, because that was based on this exclusion amount of $12,060,000. So let's pop back in here. Here we go. So there's our exclusion. Of course, he's already paid gift taxes, leaving only $150,280 of current transfer taxes to pay. That would be his estate tax during the year. Okay, so $150,280. Let's redo Dylan, except this time he's going to be the Dylan that did take the unified credit against his earlier gifts. So in this case, we calculate his gross estate, same 13.5, deduct out those things that we can exclude, we get down to 12.4. Notice that we do not have to include the taxable gifts after 76. Why? Well, because we already paid tax on them. So we end up with a tax base of 12.4. We multiply that by the same rates we saw, so 12.4 minus $1 million times 40% plus 345.8, we get 49.05,800. Now we have to adjust our unified credit, because remember, our unified credit was 4,769,800, but we don't get all of that because we used a part. And you would think intuitively that you just reduce it by the 19,320 we used, but no, you don't. Instead, you take the taxable gift and multiply it by 40%, because that's the rate that's going to apply this year to all the gifts. So that means we reduce that unified credit by 84,000 times 40%, and we end up with a unified credit of 4736200, which means the unified transfer taxes due are 169.6. Notice that is higher than we calculated that previously. The reason for that is we're only getting so we only paid taxes of 19,320, but we're reducing our credit at a 40% rate, even though the tax wasn't calculated at a 40% rate. We do that because that is the rule. We have no choice. Okay, so note that using the unified credit against a gift tax at lower rates can result in higher tax. And that's because the rules force that credit reduction at 40%. But the taxes we paid, or would have paid, back when we gave that gift, that inter vivos gift, were below the 40% rate. I guess that's just the price for taking, part of your unified credit early. Okay, so that's it for transfer taxes. We're never going to do anything more weighty than those problems, and those are pretty difficult problems. So that's a good answer. We're not going to become transfer tax experts in 624. Okay, so let's shift gears a little bit and talk about all the different types of taxes there are. There's income taxes, sales taxes, property taxes, blah, blah, blah. The book does a reasonable job of really describing what all those are. It talks about local income taxes as well. And it talks about property taxes, but what I want to do is focus in on California property taxes because, well, probably most of us live in California. Okay, so typically property tax in virtually every other state is based on the value of the underlying property. And of course, the primary source of property tax comes from either residential real estate or commercial real estate, right? So it's from everyone's home, right? Anyone who owns a home probably gets tagged with a little property tax. And if you own an office building or a warehouse or whatever that might be, you're also going to get tagged with property tax. So again, almost everywhere else, it's the value of the underlying property. And most states have what they call a 3-year rolling reassessment window where every 3 years they reassess the values of those. They have people whose job it is to reassess. establish what the value is, and then apply the tax rate to whatever that value is. So housing prices go up, your taxes go up. Housing prices go down, your taxes, though they hardly ever take them down, they go down. Okay, let's talk about California, however. Before we get there, things to look out with property tax. So often government-owned property and nonprofit property, think of like churches, they're often exempt from property tax. Property that's being used as a farm often has a lower rate. Most states give what's called a homestead exemption. So if it's the property you live in, if it's your principal residence, they actually give you a small exemption amount against the value of your home. And then some states give you a lower rate if you're an older adult. The idea being, you're on a fixed income and value of your home is going up, but your income's not going up. And so as a result, they lower the rate to keep it more affordable. Of course, all that assumes that they're reassessing the value. If the value is kept at its lower base value, then you wouldn't need to lower the rate for older adults because their property taxes are fixed. Okay, so property taxes on real estate, very common. Property taxes on personal property are far less common. Let's talk about California Prop 13, because this passed, more than 2 years, 20 years ago, probably even 30 years now. And basically they said, this idea that we're going to go in and reassess the value of your property, we're not going to do that anymore. Instead, what we're going to do is we're going to fix the value based on what you paid for it, when you paid for it. And then we're going to put a cap on the amount that it can increase in value each year until you have a change in ownership. So basically until someone else buys it. When someone else buys it, we reset the assessed value at whatever they paid for it. But in the meantime, if you've held your property for 25 years in California, your assessed value is probably much, much lower than the actual value of that property. Okay, so again, at a change in ownership, the assessed value is reassessed to bring it up to current market value. Okay, so what are exceptions to change in ownership, right? Because obviously if you just sell it, that's a change in ownership. But if it's a transfer between parents and children of a principal residence, then that's not subject. That's not considered a change in ownership, and the base value just continues as to what it was. If you have a transfer between parents and children of something other than their principal residence, then there's a $1 million cap on the amount of base rate increase that you can protect. And I'll do a calculation of that to show it to you in a few slides. So then Prop 19 came along, and I believe we voted Prop 19 in 2020. It probably started becoming effective in 2021. And basically it says any exchange of a primary residence for someone who's age 55 or older, or severely disabled, or they're being chased out of their home due to a wildfire or natural disaster. If they move into another home in California, if the value of that new home is of equal or lesser value than the value of their old home, then that base value, that Prop 13 base value, just carries over. And this is clearly built for folks who are approaching retirement. They're ready to downsize their home. They want to sell out, but they don't want to get whacked with increased property tax because they've had a change in ownership. So, they have a 4-bedroom, they raise their family there, it's now worth $1.9 million. They decide, I'm going to go buy $1 million condo. And so as a result, am I going to get whacked with that big increase in property taxes? And chances are the answer is no. If it's of greater value, so if the value of what you're buying is of greater value than the value of what you already own, then there's actually going to be an increment added to your base value. Because now, if the idea is, look, I'm trying to protect you from being chased out of your home by property tax, but you can afford a more expensive home? Okay, well then wait a second, maybe your property tax ought to go up too. Okay, so Vision and Wanda are both over 55. They sell their home. They have an old base value of $300,000, so they bought it in the 60s. It's now worth $800,000. They purchase a new home worth $900,000. So because their new home is worth more than their old home, they have to take that incremental increase in value that they're paying, right? The 800 to the 900, they have to add that to their base value. Tony Stark dies, transfers his residence to his son. The base value was $4 million, so that really should be non-residence to his son. The base value of it was $400,000 at the time of death. It was worth $1.7 million. So again, he's owned it for a long time. He's got a very low property tax assessed value of $400,000 due to Prop 13, but it's worth considerably more. So now he transfers it to his son, but remember, there's $1 million cap. So what you do is you take the base value of $400,000, you add the $1 million. That takes you to 1.4. But notice that his new home is worth 1.7, or sorry, the home that he's transferring to his son is worth 1.7. So that value exceeds $1 million, so you must adjust the base. The base value is now $700,000. That's his old $400,000, plus the increment between the home's worth at the time of the transfer, less the base value plus $1 million. That's the $300,000. So the new base value for the son is only $700,000. That's not a bad deal, right? Because he gets to exclude that $1 million increase. All right, so there are some minor changes if the replacement home is not in place until after the sale. All those rules assume that you purchase the new home before or at the same time as you sell the old home. If it actually takes you a while, there's actually a slight inflation adjustment you get to make. And that $1 million that we talked about, that's actually starting, that's going to be inflation adjusted starting next year. So if you're interested in more guidance on Prop 19, there's the website that you can go to and learn considerably more. Okay, so this is about the point we were at when I quit the in-class exercise. So we're coming to the end of this particular video. Of course, there's more to do. This is the Case-Shiller Index, and the Case-Shiller Index is it's like the Dow Jones or the S&P 500, except it measures housing prices, particularly, residential housing prices. This is not about office buildings. And if you look from January 1st of 1987 down here in the bottom, all the way up to the last date we had Case-Shiller Index information for, we've had an average increase over 35 and a half years. And that's a geometric mean. That's not just a simple average. That's not the increase divided by 35 and a half. That's the actual compounding growth rate of 6.11%. So, a lot of times we think housing has really gone cuckoo for Cocoa Puffs. And if you look over the since 2020, it kind of has, right? But if you look kind of in the grand scheme of things, 6.11%, it's not a ton. If you look at stocks over the same period, they've gone up 5.39%. Okay, this is, that's the last slide that we covered in class, so I'm going to stop the video here. The next video will pick up where this one left off.